In this video, guys, we're going to look at, is this a better way to invest in IPOs? Stay tuned. Hey traders, warm welcome to. Alright, so this is a question, should you buy IPOs as soon as they come out? And I've got no statistical data to back this up, but when you look at all the big IPOs, it seems to be a mixed bag. You know, you look at Facebook, for example, that got hammered straight away after the IPO. Okay, got a little bit of rally, then it just got hammered a long time. You look at IPOs, even in the UK market, like recent Footasylum IPO, down heavily, a little bit of rally, down heavily since then, recently been bought out for something like, I don't know, 50% of the value of the IPO, something like, it might not be that low, but it's a loss anyway to whoever bought in the IPO. So there are, of course, IPOs like Tilray, etc., that have just ripped to the upside. So is there a better way of actually generating income from an IPO or generating a capital gain from an IPO? I think there is. So let's assume you do your due diligence from a fundamental perspective. I'm not the right guy to kind of do a video on that. Fundamental analysis is something that you need to look into yourself. You need to kind of look at the balance sheet of the company. Main thing for me would be who's running the company, who's the manager of the managing director or the CEO, who's the team, what sort of pedigree have they got, what's the business model, what's the likelihood of disrupting an industry, where's the risk coming from, what's the capital requirement, common sense stuff that just as a business, from a business perspective, and then, you know, maybe find some more metrics to look at from someone who's more into the fundamentals and balance sheet type stuff. So that's one side, you've decided to invest. Now, price action is my thing, and so I would add an extra layer onto it of price action. So what would I actually look for? There's a couple of things I would look for, and for me, I treat IPOs as if they are gap stocks. So the way that I trade gap stocks intraday, I use the same kind of process for trading IPOs. And that's to say, all right, you've got a brand new print just coming from nowhere there. It's just out of nowhere, it's the IPO. Now, to me, it doesn't matter how much of a difference it is from the actual IPO price to the first actual trading price. Generally speaking, there's a premium on that, but as we've seen in many IPOs, often that's undone very, very early on. And as more and more IPOs come through, the investment appetite, if the investment appetite wasn't that strong, then you might find there's a bit of a difference between that. But it doesn't matter. What the most important thing is what's happened afterwards. So generally speaking, you know, IPOs will maybe lift up and then they will come down. Okay, not always, obviously someone's going to rip off. So how do we decide where to trade and where to invest in it? So I think the key thing when you're investing in IPOs is to steer clear generally of anything that's doing this. Now, to me, that's a separate trade then. If you've identified an IPO and 6 months later it's bottoming and you decide to invest, that's a separate kind of strategy, right? It's something you've decided to do, you like the company, you think it's good value, that's separate. So forget about that. But what about when we open and we start to drive? Now, for me, this is a bit more interesting because the obvious stop loss is going to be under the kind of open price, if you like, or the low of that first day. That's so crucial. And so you can either trade it from a swinger trade perspective, but even better for me is if you look at an intraday perspective and you look at the candle intraday and you go, right, okay, there's the first candle. Where do we close? If we close on the highs, maybe just treat that as there is a big supply and demand imbalance. And so buying on the next open, using a stop under that and seeing if you can get some strength on it. The point is with these guys is that it's a challenging way to trade. You've only got limited information, but when the other side of the coin is that the risk reward ratio is potentially very, very tasty, because this day, yes, it'll be a big range, but we've seen IPOs that have doubled, trebled and more. And so the chance of an opportunity for a significant return is quite big during IPO. Yes, you're kind of taking a bit of a punt, if you like, by trading it this way. But if we're looking to identify this kind of thing, if we're trying to avoid this type of thing, and yes, I recognize there's a similarity here where this could go down here, but you know, we're protecting against that because we want to have a stop under that first day low, which would be here. So theoretically, we're not going to lose too much. So, and again, forgetting about the fact that's a different trade if you traded that after that. If we're looking for aggression and momentum off the open, off the first few days, then trade it accordingly and just say, okay, well, I'm going to jump on the momentum rather than just buying it and hoping. Let me see how the first day at least pans out, or if you prefer, the first week, get the first weekly candle in and then make a decision. Because I think the problem that many traders have, and I fall into this trap myself, you buy on day one and maybe it kind of holds around me, doesn't do too much, but where do you put your stop? It's very difficult to put your stop. The obvious place to put your stop is after you've had day one. There's the benchmark and there's the low of the day. That's what's happened. Very easy to quantify the risk. And then the rest of it kind of falls into place. The probability of success is probably relatively low. Maybe it's 50-50. It doesn't matter. The point is you can quantify the risk. The risk-reward ratio, if you're right, is quite high, which is why I think this is a better way to invest in IPOs. So wait to see what day one, day two, day three is like, and then start to place a trade, and then maybe say, okay, well, I'll have a stop loss if it's there, because I don't want it to start doing work down here, because it shows that there's a lot of people dumping stock and we could be in for a significant down move before we then later come back and recover. Some never recover, but some do then come back and go to, you know, all-time highs and further on, as we've seen with some of the kind of tech stocks. But that initial impulse from day one, day two, day three, day four, potentially day five, viewing that and then taking a judgment on what you see there, depending on how aggressive you are, obviously, taking a judgment on what you see there and you're putting the stop in a kind of interesting place below the low is an easy way to do it. If there's another level of support, then fine. And then investing in that way and saying, okay, that's the way I'm doing it. I'm using a trader's methodology, but I'm also looking for a longer term play because I've done all my fundamental research. That way you're not completely exposed to being caught out. Because a lot of people got caught out in stuff like Facebook that just, you know, ripped to the downside. They got rid of it, didn't like it. And next thing is, you know, multiple years of massive growth. So flipping it around a little bit, use a bit of a trader's methodology with your investors thing, mesh it together. That may be a better way to trade and invest in IPOs. Take care. Bye-bye.